what happened? The stock was up this morning before the call. It was a beat and raise quarter, and now it's down sharply.
It was, and yeah, I mean, we had a good quarter. We had a solid quarter. We did what we said we were going to do, and and as you said, we're looking to land the year. We have line of sight to kind of closing out the year pretty well. Inventory, as you rightly called out, is a story, but our inventory situation, I think, is a little different than many other people out there. We didn't quite have the same hangover from COVID, as others did. So we're actually really quite comfortable with how our inventory is looking against our growth expectations for next year. Margin is challenged, of course, because of the large promotional activity that's going out there at this moment in time. But, we're focused on our strategic priorities, executing what we said we were going to do. We have new leadership in North America, and we're focusing on making sure that we grow in this important market.
So explain the inventories just a little more, because I think it came as a surprise to people, Colin, who had seen you previously as more lean with inventories. When does that come down to more normal levels?
Well, our inventory was very lean last year. If you go back and look at what we published last year on inventory, it was very tight. We were running a constraint model for the past couple of years, and add to that, we decided that we were going to cancel a number of orders as we went into as COVID really bit into the supply chain. So we didn't have the same hangover from an inventory perspective as we came into this year. But obviously, we're now seeing, as the ebb and flow of the business continues to grow, and we look to set ourselves up for success for 2024, our inventory is right sizing. And our inventory is running around about 3 times what we, three turns, which is kind of what we expected to be and what we needed to be for the size of business that we have.
So, Kevin, ultimately, the question is, what is the strength and performance of the brand? Is it resonating? And why aren't we seeing growth in key spots like North America and in apparel?
Sarah, thank you. It's great to be with you all today, too. First of all, it's a brand new day at Under Armour. And first of all, I have a lot to thank to Colin sitting right here, getting us to this point. But with new leadership, a new CEO, and Stephanie Lennartz coming on board, Patrick Weitzel, Carolyn Everson joining our board recently, we're really excited about where we are. The brand, I think, is in a terrific place. And if you look at how difficult it is in our industry, to break through, one of the things that we've been able to do was, establish this good, better, best. If you think about the landscape of what product or apparel looks like. That good, better, best is broken for Under Armour, is that right now we've built about a $6 billion with a lot of good, with some better, and nowhere near enough best. The focus for this next chapter of the brand is where we're going to really chase ourselves into, I think, doing it the right way. And you feel that happening with the brand right now. We're going to have things that you can look and you can point to, like our new Slip Speed launch, which will be kicking off next week in New York City. We've got in the Flatiron District, we're opening a pop-up store for it, but a concept that we teased out in October of last year. We'll be doing the global launch this quarter. And it really puts us in a position as we think about that next $4 billion. If you look at $10 billion, the way we have outlook for growth, we've built $6 billion that we have of that good, better, best mix. The next $4 billion that comes, we see really prioritizing on the better and best side of things.
And I would just add, if you look at the growth we're seeing in Europe, the brand's doing incredibly well in Europe. So the model works, and that's the strategy of how we make that work in the U.S.
I guess, Kevin, the question is, how do you sort of reignite the brand around some of your growth areas, like I know varsity sports and overall team sports in a difficult promotional environment and potentially deteriorating macroeconomic environment?
Well, Sarah, you said it. We're still coming off of, as we move into this new strategy that we have as a brand, we've renamed our target consumer as the 16 to 20-year-old varsity athlete. That means whether you're a freshman, whether you're a senior, whether you're someone that just used to play high school or team sports, we're still making product that's relevant for you, but we're doing it in a light of something that actually increases the TAM of this company. So our addressable market went from about $100 billion under the previous strategy to more than $300 billion. That's going to take us from focusing just on what the athlete's wearing when they're actually competing on field, on court, on pitch, in the arena, to focusing on those other 22 hours of the day. Actually, something we're focusing called tunnel walk, which is how do athletes get in and out of the stadiums and how they look with style. But of course, it'll have the UA DNA of performing in everything that we do.
So, Colin, how would you describe the consumer environment? Are you seeing any evidence of a slowdown tied to the economy in North America?
Well, it's not easy out there, is it? You know, we've seen a lot of other people post results. I mean, but at the end of the day, we're focused on doing what we do and keeping the main thing the main thing. You know, we're confident with the strategy we have in place, and we believe that as we continue to lean into that, we have line of sight to a pretty interesting year next year. We're seeing opportunities certainly more on our own DTC channel, and there's something which we're focusing on and continuing to invest in.
How much longer is it going to be promotional like this?
Did you want to?
Let me say this, is one of the things we think that we have been able to see is the beauty of being a global business now. It gives us a lot of tentacles to see around the world. And we look at Asia Pacific, when we look into EMEA, you know, EMEA was plus 30% for us this year. And so we actually have it, quote unquote, going on in North America. But we are taking, as part of our strategy, is a real hone in and focus here at home to make sure that we win in North America, so that we win those hearts and minds and really focusing on kids. And you'll see our strategy, you'll see our dollars. But we don't feel like giving up any ground. We don't think we have to do that. We have the momentum working in other parts of the world, but really honing in and focusing on winning here, winning in our own stores, winning in our DTC, and supporting our key retail partners is really part of the focus. And they're going to do that with great product.